Hi guys, I'm Andy Willson. I am the Sneakonomist. And in this series, we've been looking at the implications for businesses in the sneaker and apparel industry through 2020. Obviously, with COVID being the dominating story throughout. In this episode, we're going to look at Q4. We're going to look at now businesses being able to reopen and actually what the new norm is starting to look like. If you missed the previous episode, the link is in the description below. There we looked at businesses once they were just starting to reopen after lockdown and the struggles that they were having, etc. But in this one we're going to concentrate on Q4, where actually things are starting to get into a little bit more normality, and businesses are looking at how they can actually change for the better going forward. So now we're looking at government stimulus and furlough being taken off the table. And this itself was having ripples across the sector. If you were a business and you were going to, the furlough schemes, etc., were looking like they were going to run out, you would have to start fully paying your staff again. So we found that some of the businesses were actually having to make tough decisions, and we saw another rounds of redundancies coming through. The struggling high street picture continued. It was struggling before COVID, let's be honest, but COVID made it even worse. Department stores in shopping malls have been a big focus purely because their stores are so large, the footprint's big, the cost to run those stores is pretty astronomical, when all that's happening is the amount of money you're making on selling these products, or your margin is getting squeezed. So we saw these department stores and the concessions, some of the concessions within them, that were particularly struggling. If I pick one, for instance, in Debenhams in the UK, they had already gone through a CVA, which is a company voluntary arrangement. It's almost like a way of going into administration when you're calling in receivers, if you like, to help you to be able to pay off what you owe to suppliers. It's sort of almost like a CVA is like an off-the-shelf way of doing it. What you would hope to do during this period that you're in the CVA is that you can rejig the business, get it into some kind of form that is profitable again. You can pay off those debts that you had, or come to an agreement with those debtors that you owed money to, and then you can restart the business, if you like, in the same name, but going forward in a new shape and hopefully profitable. But what COVID did, particularly for Debenhams, who were in a CVA from last year already, was it significantly hampered their attempts at getting the business back to a profitable level again. What we've also found now is that trend changes that we saw through the first half of the year and into the second half of the year, people are becoming more accustomed to that. I read an article that states it takes about 60 days for something that you do to become an actual habit. So when we're much more heavily reliant on our apps and online purchases, etc., that is what we're starting to see as a bit more of the norm. I mentioned previously in one of the episodes about DTC, that direct to consumer, these manufacturers that are making the product themselves, selling it themselves, not via a third party, a Foot Locker or a JD Sports. So they're manufacturing and selling it themselves either on their own online platform or in their own stores. We saw at the early parts of the COVID issue and the move to online, the DTC, it was already a big push for these brands anyway, but they were pushing through 30% of their sales. So I talked previously about DTC, or direct to consumer. This was manufacturers themselves making the products and also selling them on their own platform, so the online apps, etc., or in their own stores. At the beginning of the year, and as we saw that leap in online sales due to stores being shut, the DTC numbers, which is something the brands were already pushing towards anyway, had moved from in the 20% through 30%. And some of these brands like Nike had long-term ambitions of it, DTC becoming sort of 40% or so. What we found is this move to online has sort of expedited this increase in DTC, and Nike are now talking about hoping to get it to up to 50% of their sales in the coming year. Other things that Nike, for instance, have done as they've been tweaking throughout the year, they came off Amazon Marketplace. The reason that Nike went onto Amazon Marketplace in the first place is that they wanted to be able to force out fake sales of shoes by trying to control the marketplace themselves. This didn't work, so they were unable to do that. So in the end, they admitted defeat and have come off that. They also are stopping supplying to certain smaller businesses. For instance, one of them, actually, an online business called Zappos, which is a top 5 US online seller. They have stopped supplying them because clearly the less big places online that you can sell your stuff means people are more likely to go to your own platform. They've also, unfortunately, which is another nail in the coffin, if you like, for the high street, is they have stopped supplying to some of the medium and small wholesalers as well. This is something they were already doing with this DTC push going into this year, but unfortunately with the onset of COVID, etc., it's meant that some of these businesses were unable to survive, particularly with the threat of them being removed as being able to sell Nike products. This helps the firms with big scale, the JD Sports, the Foot Lockers, etc., who have got the massive accounts with the brands Nike, Adidas, etc., and has meant that they can get a bigger piece of the pie. We've heard from Sports Direct this year that have been complaining they don't get the same quality of shoes, etc., that some of the other bigger retailers and stuff are getting, but that's because Sports Direct are selling more run-of-the-mill products at cheaper prices. So what they don't want to do, the brands don't want to start pushing their high quality stuff through there in case it devalues them. So health and exercise we've talked a lot about. This was a big part. Not only was it about how your body, you could cope with COVID if you caught it. If you were healthy, you were less likely to be suffering such severe symptoms. But also we saw a big increase in mental health issues as people were locked down and stuck inside. So people started to exercise to be able to get out and about. So again, we're looking at apps monitoring this progress and offering loyalty, etc., and pushing sales via these apps. Unfortunately, what we've found as we come towards the end of 2020 is that we've seen spikes in COVID cases. For instance, in the US, we're now seeing the evidence that Thanksgiving, people getting together, we're now seeing large spikes in numbers there. So we're starting to go back into lockdowns, more regional as it stands at the moment, but those lockdowns are kicking back in. This is hampering the Q4 recovery. Now, obviously, we've heard recently about some hopes around the vaccine, and we've started to see it being rolled out in the UK, and it's starting very soon in the US and in other countries as well. What this has done is, with the stock market and the valuation of businesses, it's given some kind of potential end to this issue, or at least being able to be on top of this problem. So what we've seen initially in March, when shares were hit 40-50%, we've actually seen, if you were to draw it on a chart, we saw sharp drops, and then we started to see just a steady climb, and markets are going back to their all-time highs. And people, chartists, etc., people call it things like a V-shaped recovery or a U-shaped recovery if it's slightly more delayed. But quite apt for this channel, people are describing this recovery as a Nike swoosh, because we saw the sharp fall and the more gentle recovery. So That's the end of this episode. In the next episode, I'm going to be looking into 2021, when hopefully the economy is getting back to some kind of normality, and how the businesses are going to be changing for the long term. But let's not forget that the vaccine takes months to get rolled out, so it is going to be still eating into next year.